Hey everyone, NIO filed its Form 20F on April 9th that gave investors a lot of key information about the company. So in this video, I'll go through NIO's 20F statement and understand and explain and evaluate what it could mean for NIO stock investors. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so let's start with NIO's results of operations. And the four key items I'm going to look at is revenue, cost of revenue, sales, general and admin expenses, and its loss from operations. So let's start with total revenue. In 2021, NIO generated 36.13 billion RMB in revenue, and in 2022 that increased to 49 billion RMB in revenue, which then increased to 55 billion RMB in 2023. So one thing to note here is that the growth rate in revenue is slowing down. The company grew at roughly a 33% growth rate from 2021 to 2022, and that slowed down to roughly 10% in 2023. Now, the EV industry in China, in Europe, in the United States, in the world really has slowed down in terms of the rate of growth. But at the same time, the EV industry has substantially increased the number of new models and the number of new units that are in production. So supply has increased dramatically more than demand has increased, and that's been bad news for a lot of EV companies, including NIO. Now, one of the downsides of the increase in supply is that the price of materials increase. So you're competing with other car companies that are going out and buying those same materials to produce those electric vehicles that you are. And so the price goes up. Suppliers are happy about it, right? Those companies that are supplying EV companies, they're happy about all these companies coming out with newer and newer models, and that's giving them even more and more money. But the EV companies overall have not been doing great. And you can see that in the total cost of sales. So for NIO, its total cost of sales increased from 29 billion RMB in 2021 to 44 billion RMB in 2022. Now, the really bad thing about this is the change in revenue versus the change in cost. So let's look at that. Revenue increased by roughly 13 billion RMB, while costs increased by roughly 15 billion RMB. So costs are rising faster than revenue. That's a bad sign, right? Companies like NIO that are newer, that are just starting out, it's understandable that they generate losses on the bottom line. But what you want to look for as an investor is when this company is growing, you want to see revenue grow faster than cost. That way it's making progress towards profitability. NIO is not doing that. It's going in the opposite direction. As it generates more revenue, it loses more money on the bottom line because its costs are rising faster than revenue is rising. And similar trend for 2023. Revenue increased by roughly 6 billion RMB, while cost increased by more than 8 billion RMB. So in the last 2 years, revenue has increased, yes, but that rate of growth is decreasing. Secondly, cost of sales has increased at a faster pace than revenue. So bad signs to be sure for NIO stock investors. Additionally, selling general and administrative expenses. This is my least favorite category for a company to increase costs in. My least favorite category, because this is where a lot of waste can happen. I don't mind if a company spends money on research and development because that's where they create new products and services that generates revenue, cash flow, and profitability. Selling general and administrative, especially when they lump selling in with general and admin, I'd prefer them to separate selling because that's more marketing and advertising, and then general and administrative, which is more corporate expenses. I'd prefer these two categories to be separated out. Nevertheless, NIO is combining these, And one thing I'm especially curious about with NIO is the NIO house strategy. I don't see the benefit in that. I've looked at these NIO houses. They look cool and everything, but how is that going to lead to increasing sales and cash flow and profitability at an efficient scale? How is that going to lead to more revenue than it is going to lead to more cost? It looks really expensive, and it is really expensive, as you can see, the SG&A expense being so large and the benefit being questionable at the best. So you can see SG&A increasing from 6.8 billion RMB to 10.5 billion RMB from 2021 to 2022, a roughly 4 billion increase in SG&A, and it's almost 33% of the increase in revenue came from an increase in SG&A expense. That's too large, in my opinion, to have that kind of increase in your SG&A expense when your revenue barely increased by 33% and when your company is losing so much money on the bottom line. You've got to have a culture of keeping costs under control if you want to survive for the long term, especially when you're battling in an extremely competitive industry. You want to be very cautious with the expense, and it doesn't seem that NIO is as cautious with the expense as I would like as an investor. Now, those same SG&A expense increased from 10.5 billion to 12.8 billion RMB in 2023, which led to rising loss from operations. You can see its loss from operations, 4.5 billion in loss from operations in 2021. That more than tripled to 15.6 billion in 2022. And that increased again by roughly 50% to 22.655 billion in 2023. And again, these are rising as revenue is rising. So the more sales the company is making, the more losses it's leading to on the bottom line. And there is little evidence that this trend is improving because you don't see that here in the financial statements. All you see is growing revenue leads to more cost, leads to more losses. So they're not demonstrating improvement in the critical financial metrics that I would like to see as an investor. So management explains some of what was going on here, at least from 23 to 22. They state that the revenue increased by 12.9% as a result of increasing deliveries, but the average selling price dropped by 15.7%. That's a result of a different mix of models and the price competition in China. Although NIO hasn't really participated in the price war the way that other Chinese automakers have, still, it's experiencing the downside of the price war in China and worldwide for electric vehicles. Cost of sales, meanwhile, increased by 19.1%. So that revenue increased by 12.9, cost of sales increased by 19.1. You don't like to see this as an investor. And they say that they're experiencing lower material cost per vehicle. So that's a bit curious that their cost of sales is still rising more than revenue, despite the fact that they're saying that they're getting lower material cost per vehicle. That must mean that labor expenses rising significantly faster. And then they say gross profit decreased by 40.7%, driven primarily by a decrease in profit from vehicle sales, primarily due to the lower selling prices. So lower cost models, that might entice customers to buy more, but it also leads to lower profit for these companies, and they're already losing so much money that this is not in their favor. So gross profit margin fell to 5.5% in 2023 compared to 10.4% in 2022. And then the other sales segment in the business in 2023 was negative 25% compared to negative 29% in 2022. So while it is still negative, at least the margin improved on the other sales segment, whereas the gross profit margin was unfavorable. So you can start to see why NIO's stock price is down from $62.84 at its high down to $4.09 as of this recording. So the company's performance is leading to the decreasing stock price. Understandably so. If I saw a company performing like this, I would run away from it as quickly as I can. I would try and avoid investing in companies like this. Now, NIO stock price is still higher than its lows of $1.32 in 2019. It's still more than, double, almost triple that valuation. Remember, in 2020 and 2021, there was an absolute frenzy for electric vehicle stocks, which NIO participated in and experienced that boom in stock price before it really proved itself as a company that can sustain and profit and generate cash flow. Now that it's come back down, I still don't see it as a bargain because of the metrics you're seeing. A company at this scale losing this much and demonstrating little progress towards profitability, I don't, even at $1, I wouldn't feel confident in buying this stock, even at $1. So this company needs to really demonstrate sustainability. It needs to demonstrate improvement in profitability. It needs to stop the losses on the bottom line, do a better job of controlling costs so that it can demonstrate to investors that it has a strong capability of competing in this extremely competitive industry and surviving for the long term. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.